welcome to Street Signs on CNBC TV 18. This is a show where we map the global and the local cues and get market experts to tell you what you should be doing in this bull run. Today we have two guests who join us. Nilesh, Shah, the MD and CEO of Envision Capital, and Sanjay Dutt of Quantum Securities is also with us on the show. And Udayan Mukherjee, as always, joins me as well. Hi Udayan, thanks for joining in. It's been a great, smooth run for the market, a 10% up move in the last 3 months. You reckon this good run will continue?
Hi Sonia, I think the market's witnessing some incredible momentum globally and locally because you've got a unique combination of many things which are going for India right now, which is that there's a lot of liquidity sloshing around in the world, not too many avenues to park it in, and India is showing gradual improvement in its economic metrics, and there is a lot of hope that policy will unshackle much more of this growth in the next couple of years. So we are the beneficiaries of a fairly significant dollops of global capital. On the margin, our macro and micro is improving. Crude prices have come down. So I think India stands at the cusp of a very big global relative trade, which we are benefiting from. It's just that in the last 3 weeks, we have traversed a lot of ground. The market's no longer at 7,700. We've had this big rally to 8,300 plus. So maybe in the near term, things have got a little overheated. And I won't be surprised if there is a bit of a corrective dip lurking somewhere ahead, which is not to say that eventually will not go much higher. Still hold my targets of 9,000 plus on the Nifty before the union budget, and there's nothing which has happened to change that view. But I just think in the near term, from a trading perspective, even if the market were to run on a bit more from here, it may be prudent to just skim some profits because of the very good run that we've had already in the last 3 weeks.
So if we do get this dip, then will that be a buying opportunity, Udayan? And if yes, what would be the sectors or pockets to look at? Will it still be some of the private sector banks, or should you look outside into cyclical names, etc.?
Well, cyclicals have had a great run, Sonia, over the last few weeks. Results have been mixed from some of the cyclical sectors. If you look at autos, results have been mixed. Some have been very good, some have not been very great. If you look at industrials, the same is probably true. So I think the best thing right now is to, as you suggest, buy the dips, because in the last 6 or 8 months, we've got 2 or 3 of these dips in the market of 5% plus. They've not been very deep, but those have been buying opportunities. And I think that remains the kind of script for the market for now, that you utilize any of these 300-400 point dips in the market to keep accumulating, and then just lay off a little bit when the market gets very hot, as it seems to be right now. Private banks have run quite a bit, but I still think eventually they will go higher. So on dips, they still remain a good buying opportunity, maybe not just right now. I would look at some of the side sectors like cement, media as well. Some of them have turned in good numbers. Consumers and IT are the 2 areas where results have been slightly disappointing. So maybe you need to give them some more cooling time, and maybe some of the public sector banks too, because results have not been great. The valuations have become tempting once again in that space. So some cyclicals, yes, but maybe some of the stronger sectors too. But broadly, generally, the principle would remain in my book still that you need to be buying the dips. And from a trading perspective, I think 7,700 has turned out to be a fairly significant bottom for the market. And even if there is global turmoil ahead at some point, I think it will take a lot of breaking that level where we bounce back from in the middle of October.
All right, let's pose all of those questions then to our first guest who joins us. Sanjay Dutt of Quantum Securities is with us. Hi Sanjay, thanks for being with us on the show. You know, I don't mean to dampen the enthusiasm, but towards the fag end of this week, we got some disappointing numbers from public sector banks like Bank of Baroda. We had the weak consumer trends that played out as well. What has your understanding been of earnings season so far, and how would you approach some of these pockets?
I think earnings haven't been that good. In fact, relating them to the price, I think price has run up ahead of the fundamentals, as Udayan was just mentioning. We are still about a few months away from a real robust recovery, which will be reflected in the earnings. So I'm not too surprised about the earnings, because I wasn't expecting much of fireworks there. And I think, you know, it's the global liquidity, the momentum, the euphoria that's coming out of, you know, the Japanese liquidity, the ECB statements, the Eurozone statements, etc. That's what is driving up the rally more than the real fundamentals on the ground in India as yet.
Hi Sanjay, good to see you again. Would you play for a bit of a correction then at this point, or do you think it's better to stay with the momentum?
No, I would play for a correction at this point of time. In fact, more than that, I think we'll see a typical kind of a bull market play out here, where we see rotation coming in. We may not see a substantial dip or a rise, whichever way, in the Nifty as such. But within the Nifty, within the market itself, within the broader market, we'll see a lot of churning. The stocks that have run up ahead of their fundamentals would pull back. People are looking for new ideas. I think a very important thing that we all need to note at this point of time is that domestic investors at large, both institutional as well as retail, have a left out feeling, in the sense they haven't really been able to position themselves from this, for this rally that we've seen. So they're all now wanting to creep in and look for ideas. I see a lot of private client group as well as the quote-unquote, the active operator category in the market, who are now looking for ideas. So they are the ones who will actually provide the floor. So if I would want to play it, I would play it for very, small moves on the short side.
Where would you be looking to buy, Sanjay? Because prices have run up in quite a few sectors quite significantly. But if you think the correction will not be very meaningful, which are the sectors which you still think hold a lot of value for investors who've missed out?
I think capital goods, is one place where I think there's a lot of potential. Banks, I still see a lot of potential, because we will see the cleanup, recapitalization, all those moves starting to happen and pan out over the next 12 to 18 months. So select a good quality banks, both in the private and the public sector. Engineering, capital goods sector definitely looks very exciting at this point of time. I would want to buy them if I see a dip. And in addition to that, I think oil and gas continues to be a space that I like, because this is the first time probably in decades we are seeing a perfect situation where government is very clear that they want to set right this subsidy mechanism. Oil prices have fallen down. So therefore we've got a perfect situation where a lot of things can happen right on the policy front for the sector. The gas pricing issue that's been plaguing the sector for a few years would be resolved over the next few months, and in fact first stage resolution has already started. So that's one place I would definitely like to lay my bets in case I am looking for some good quality large caps.
What would you do with some of the auto stocks now, Sanjay? I mean, the festive season has indicated that the sales have not been so great. Would that make you wary of putting fresh investments into this sector?
I think the auto sector on the whole is really priced to perfection at this point in time. In fact, in some of the pockets maybe much ahead of the fundamentals. Of course, they would gain in case we see interest rates coming down, consumer spend, and the consumer EMIs coming down, etc., etc. But I think they already, most of the positives are priced in. Of course, foreign commodity prices would benefit them in terms of input costs, etc. But I think all that is already in the price. Till I don't see a substantial sell-off in them, I wouldn't want to position myself in any of the auto stocks as yet. No. Okay.
Are there any specific mid-cap pockets or stocks that have caught your fancy? One, maybe because of good earnings, and two, perhaps because they've fallen so much that a recovery is still underway?
I think, Sonia, there are many of them across sectors. I can't really, pin them down to a specific sector. In fact, in a rising tide, all will do well. In fact, some of the boats will sail faster. So therefore, companies with, no debt or lesser debt, companies that have really run tight ships, companies that are owner-manager driven companies, those I think are well positioned, whether they be in consumer goods, whether they be in capital goods, or many other sectors. In fact, quite a few niche sectors are coming up now, which are linked to the e-commerce boom that we are seeing. But very difficult to find stocks, very difficult to find pure plays there. One needs to do a lot of work in trying to locate good quality mid caps and small caps. But I think that's where big money is going to be made. There are a lot of mid-cap stocks in the engineering construction sector, because once we see the government spending, government allocations start going up, the capex cycle start looking up, these companies will start looking good again. The ones which totally got slammed because of liquidity issues and order flows, etc. The likes of, the Jyoti Structures, KECs, all these businesses will be really back in vogue and will be making good money over the next 3 to 5 years.
What about the sectors which have run into a bit of rough weather of late, Sanjay? IT after the earnings this time around has started underperforming, and the consumer numbers have not been great. How would you approach these two names?
I would be underweight then, because I think these sectors have been overowned for the last few years, particularly amongst institutional portfolios. They've been perfect safe havens. They're overowned, so therefore that's one reason why I wouldn't want to be in them. And because they're overowned, and there are few companies which actually have had least amount of corporate governance issues also, and of course they've had least amount of debt problems also. So I think they're priced to perfection. In fact, some of them are actually expensive at this point of time. And picking up from this, I've been reading reports last 2 days that the government will run out of its, will not be able to meet its divestment target, may resort to expenditure cuts, etc. I don't know how far those news reports are correct, but if the government is going to resort to expenditure cuts and those kind of things, I think that's bad news, because it's not able to reach divestment target. My simple suggestion is there are 3 companies which are lying with the government, non-strategic, have nothing to do with the government, which are part of the erstwhile SUTI, that's ITC, Axis Bank and L&T. In fact, they are the ones which the government should immediately sell, because all of them are on the upper end of the valuations. And this is the perfect time to get rid of them and easily garner about 60 to 70,000 crores cash. And most of the problems relating to deficit, the divestment target should be met.
Sure. Sanjay, always a pleasure. Thank you very much for joining in today.
Thank you.
We'll be back on Street Signs after a quick break with Nilesh Shah of Envision. Stay tuned.